What's happening, viewers, and welcome back to our channel. Cryptocurrency is a digital payment mechanism that doesn't depend on banks for transaction verification. The transactions that you make with Bitcoin money are recorded in a public database, while digital wallets are used to store cryptocurrency. The term cryptocurrency comes from the fact that it employs encryption to authenticate transactions. If you're wondering, is cryptocurrency a risk or opportunity? Let's dive right into the video. Opportunities in crypto trading. Number 3. Long-term investment. Bitcoin is the most well-known cryptocurrency. It benefits from the network effect, which means that more people want to acquire it because it's the most popular. Many speculators see Bitcoin as digital gold, but it might also be used as a digital form of money. Moreover, Bitcoin investors think the cryptocurrency will appreciate in value over time since the supply is limited, unlike fiat currencies like the US dollar or the Japanese yen. Bitcoin supply is limited to little under 21 million coins, but central bank controlled currencies may be issued at politicians' discretion. In addition, many investors believe that when fiat currencies decrease, Bitcoin will appreciate in value. Those who think that Bitcoin will be widely utilized as digital cash feel that it has the ability to become the first genuinely global currency in the long run. Number 2, you have direct control over your money. As cryptocurrency is decentralized and doesn't need the intervention of the government or any other body, investors have direct authority over their funds, so it's easy to get access. Number 1, borderless. Cryptocurrencies are used and accepted everywhere over the world with no limits on where they may be used or accepted. Their value doesn't change from nation to country as it's international. Hence, the investors may get much profit from their investment. Risks in crypto trading. Number 3, costly and complex investment. In recent years, legislators in the United Nations have enacted additional laws for cryptocurrency exchanges in order to ensure that consumers are properly registered and that their transactions are recorded and examined for tax reasons. The disadvantage is that they demand exorbitant fees to purchase and sell cryptocurrencies. You have a very limited number of options for safely buying and selling cryptocurrencies, and you'll have to pay for it. In comparison to typical investment management, the costs are quite expensive. Aside from the difficulties of securely keeping passwords and digital keys, purchasing and trading Bitcoin will be technologically challenging, with many individuals finding it difficult to activate the required software and hardware, which Gower deems a high barrier to entry. Furthermore, while the coins themselves are generated or electronically mined in a highly safe fashion, the dangers arise from the means individuals use to acquire and keep it, as well as the tax ramifications of doing so incorrectly. One should have experience and proper guidance before making an investment in crypto. Number 2, security risks. Some banks now provide services to assist users safeguard their cryptocurrencies, but they charge very hefty management fees to do so, as set by many investors. According to some investors, certain online brokerages also handle Bitcoin accounts, albeit with large costs and low minimum investments. Adding on, if you send coins to the incorrect account or wallet, for example, they're lost and cannot be recovered. There's nothing you can do if a dishonest trader takes coins into his wallet rather than the company wallet while you're operating a trading activity. Your coins are lost if an exchange you're trading on is hacked or if you forget your account or password. If you keep your coins on a laptop and a hacker gets in and snatches them, you're out of luck. For these reasons, you must balance the currencies you maintain on an exchange, on your local computers, and in cold storage. There are solid security measures accessible on the exchanges, but it's up to the participant to use them. They're not mandated or automatically available. The same is true if you store these currencies on your computer. If you don't take proper safeguards, they're subject to hackers. Consider storing your coins in cold storage if you're a buy and hold trader. Cold storage commonly employs a pen drive key-like device to store the private keys that enable you to transmit cash. Number 1, accounting issues. There are a few defined accounting principles for cryptocurrencies, just as there are a few recognized laws, and many regulatory organizations have yet to define what a cryptocurrency is. Is it a financial instrument, a cash equivalent, or an intangible asset? There are uncertainties regarding how issuers and receivers should account for ICOs. Are they issuing ownership in a firm, or should it be treated as a liability? Or is it a prepaid asset or intangible asset for the recipient and delayed income for the issuer? There are no solid answers yet. There are many unknowns when it comes to taxation with cryptocurrencies, but the IRS has issued some guidance. Most importantly, cryptocurrencies are taxed as property, not currencies, which means they're subject to standard capital gains and losses, which necessitate painstakingly derailed record keeping of each individual transaction. That's all for today, guys. If you enjoyed this video, don't forget to give it a like and subscribe to our channel. Take care now.